Dirty dealings, corporate battles, consumer woes. This is Evening 5. Peninsula Malaysia's base electricity tariff has been set at 45.62 cents per kilowatt hour in the 3-year regulatory period of 2025 to 2027. This marks a 14.2% increase from the 39.95 cents per kilowatt hour set in the previous regulatory period of 2022 to 2024. According to Tenaga Nasional, the hike will be effective from July 1st. Any differences from January to June 2025 will be funded through Kumpulan Wang Industri Elektrik. Capex for the upcoming regulatory period has been set at 42.82 billion ringgit, with operating expenditure at 20.78 billion ringgit. The regulatory rate of return, meanwhile, has been maintained at 7.3%, unchanged from the current regulatory period. Separately, the Energy Transition and Water Transformation Ministry said the Green Electricity Tariff or GET program will continue into 2025, maintaining current premium rates while introducing discounted long-term subscription packages to boost renewable energy adoption. The premium rates remain at 10 cents per kilowatt hour for low voltage users and 20 cents per kilowatt hour for medium and high voltage consumers. New long-term subscription options are now available for up to 3 years in 2025 to 2027, with premiums reduced to as low as 8 cents per kilowatt hour for low voltage and 18 cents per kilowatt hour for medium and high voltage users. Subscriptions will open on March 1st, 2025 via the My TNB portal, and consumers can backdate their subscriptions to January 1st, 2025. Regulator MCMC said Telegram and Tencent's WeChat have begun the process of obtaining the requisite license to operate their platforms in Malaysia next year. All applicable service providers are reminded to submit applications by December 31st to avoid potential regulatory action. MCMC's licensing framework, which takes effect on January 1st, 2025, brings social media and internet messaging services under the Communications and Multimedia Act 1998. It requires applicable service providers to have a license to operate in the country or face regulatory action. The regulator lauded Telegram and Tencent for their commitment to complying with licensing requirements, adding that both platforms are expected to meet the necessary requirements to operate in Malaysia soon. Other platforms expected to follow suit with applications for licenses include Meta's Facebook, Instagram and WhatsApp, Google's YouTube as well as ByteDance TikTok. Kedah-based Southern Cable Group has bagged a contract worth 172.57 million ringgit to supply cables and conductors. Southern Cable said in an exchange filing today that the contract from an undisclosed client in East Malaysia starts from December 20th, 2024 to December 19th, 2026. The contract was awarded to its subsidiary Southern Cable. It said the latest win is expected to contribute positively to the earnings of the group over the duration of the contract. With this new job, the group's outstanding orders on hand have increased to 871.87 million ringgit. Founded in 1993, Southern Cable has its main operation in Malaysia. It also has an established distribution network across Southeast Asia, including Myanmar, Indonesia and Cambodia. It is a registered supplier of cables and wires to Tenaga Nasional, Sabah Electricity, Telekom Malaysia, Petronas and Sarawak Energy. Shares of Southern Cable were up 6.4% at RM1.16 at the close, giving the company a market capitalization of 1.04 billion ringgit. Malaysia's automotive sector will have to contend with weaker sales of non-national cars amid intensifying competition, while the industry grapples with easing backlog orders. In a note, RHB Investment Bank flagged that the entry of Chinese brands may erode market shares of incumbents. Some car buyers may postpone their purchases in anticipation of further price cuts from both existing and new marques, which would also destabilize the non-national segment. The research house remains cautious in its outlook for next year, given the ongoing price competition between the non-national marques. It said softening order backlogs also indicate toned down expectations for the coming year. Overall, it projects total industry volume, or TIV, or new car registrations to fall 8% in 2025 to 730,000 units next year versus 790,000 units projected for this year. The House explained that this is due to the high base effect and the lack of compelling factors that will keep auto sales at the current elevated levels next year. It kept the sector on neutral and named Burma's Auto and Sime Darby as its top picks. Pan Merchant, a manufacturer of filters for solid liquid filtration and provider of steelworks and technical support services, is looking to raise capital from a planned IPO on Bursa's ACE market to expand its manufacturing plants, product development, business expansion and for working capital. According to the draft prospectus filed with Bursa Malaysia, the proposed exercise involves a public issue of 232.19 million new shares, which represents 25.35% of its enlarged issued shares, and an offer for sale of 18 million existing shares at a price to be determined later. Under the proposed public issue, the company has set aside 45.8 million new shares for the public, 14.6 million shares for eligible persons, 57.28 million shares to selected investors, and 114.5 million shares to Bumiputra investors. Pan Merchant said it has a proven track record of 37 years and is the largest homegrown solid liquid filtration solution provider in Malaysia under its PMI trade name. It has 3 manufacturing plants located in Ipoh, Perak. The company plans to grow its presence internationally, particularly in Europe.